Welcome to new episode of Inside the Economist's Mind.
Great to be here.
Today, we're taking a deep dive into something, well, pretty fundamental to Australia's economic health, how exchange rates really affect us.
A big one.
We've got the Reserve Bank of Australia's explainer, the one on exchange rates and the Australian economy, as our guide.
Yeah, a solid resource.
Our mission really is to sort of unpack the main ways a rising or falling Aussie dollar impacts our trade. The flow of money, financial flows, economic activity overall, inflation always a hot topic, and the balance of payments. Australia's bottom line with the world, essentially.
It really does touch all those areas, and it often just hums along in the background, doesn't it? But the effects are, well, surprisingly real for people.
So maybe start with the basics. What exactly is an exchange rate?
Right. Simply put, it's just the value of one currency measured against another. So think AUD versus USD.
Okay.
If the rate is, say, 0.75, it just means one Australian dollar buys you 75 US cents. Pretty straightforward.
And the terms we hear all the time, appreciation and depreciation.
Yep. Appreciation means our dollar gets stronger, buys more foreign currency. Depreciation means it gets weaker, buys less.
Got it. And the RBA paper says these shifts ripple through the economy in two main ways.
That's right. Two main channels. First, there's the direct effect on prices, how much Australian stuff costs overseas and how much overseas stuff costs here.
Okay, direct price effect.
And second, there's the indirect effect, how those price changes influence decisions about what to produce, what to buy, which then impacts economic activity and inflation.
And all this feeds into the balance of payments, too, you mentioned.
Absolutely. It all connects back to that bigger picture.
Okay, let's tackle that direct effect first. How does a change in the dollar, immediately change the price tags?
Well, take a depreciation and the Aussie dollar weakens. Suddenly, for anyone holding, say, US dollars or euros, Australian goods and services look cheaper.
Like an instant discount.
Exactly. Imagine a tourist coming here. If our dollars dropped, their home currency stretches further. Their hotels, souvenirs, coffees, all that, it all costs them less in their money.
Right. Makes Australia a more attractive destination, I suppose.
It does. And the flip side, if the Aussie dollar appreciates, gets stronger.
Then we look more expensive to visitors. That same trip costs them more of their currency.
Precisely. And it works for us, too, when we travel overseas. A stronger Aussie dollar means our money goes further when we're buying things abroad. Cheaper holidays.
Okay, so that's the immediate price signal. But then you mentioned the indirect effects kick in, particularly on economic activity, jobs.
Yeah, and the RBA paper uses that depreciation example again, which is quite helpful to follow the chain reaction.
Okay, let's do that. Aussie dollar weakens. What's domino number 2?
Well, our exporters suddenly become more competitive on the world stage. Their goods, think iron ore, wine, education, are now cheaper for foreign buyers.
Because their currency buys more Aussie dollars.
Right. So international demand for Australian products tends to increase. We expect to see export volumes, the actual quantity of stuff we sell, go up.
Okay, so we're selling more. What about imports? What we buy from overseas?
Well, they become relatively more expensive for us here in Australia. That new phone from overseas, that German car, they cost more in AUD terms.
So we might think twice.
Exactly. Consumers and businesses might look for Australian-made alternatives instead, or just buy less imported stuff overall. So import volumes tend to decrease.
More exports, fewer imports in terms of quantity. How does that ripple through the wider economy here?
So these shifts mainly hit what we call the tradable sector, first things easily bought and sold across borders.
Right.
But then there's a knock-on effect. Because we're earning more from exports and spending less on imports, overall national income gets a bit of a boost.
More money swirling around.
Yeah. And that extra income tends to increase demand for non-tradable things, too. Stuff produced and consumed locally, like getting a haircut, going to a restaurant, construction.
So even businesses that don't directly trade internationally can feel the benefit.
They often do. As demand picks up across the board for both tradables and non-tradables, firms need to produce more.
And that means
Hiring more workers. So increased demand leads to more employment, which helps push the unemployment rate down. A weaker dollar can actually be quite good for the job market.
more jobs sounds great, but
Yeah.
there's always a but, isn't there? We often hear a weaker dollar means higher inflation. How does that work?
Yeah, that's the other side of the coin. A depreciation can feed into inflation in a couple of ways.
Okay.
first, and most directly, the price of imported goods goes up, as we said. Businesses importing things usually have to pass on those higher costs eventually.
Right, so the price of that imported TV or those imported clothes might rise on the shelves.
Exactly. That's imported inflation. Second, that general pickup in economic activity we talked about, more demand, more jobs can create inflationary pressure too.
How so?
Well, if demand is strong and the economy is running closer to its capacity, businesses might find they can raise their prices. Plus, if the job market tightens, they might need to offer higher wages to get or keep staff.
And those higher wage costs.
Can also get passed on to consumers through higher prices. It's often called demand pull inflation.
So it's a bit of a balancing act. Growth and jobs boost, but maybe higher prices too. And that's where the RBA comes in.
That's their cue. If inflation looks like it's heading too high, breaching their target range, they might step in to cool things down.
By doing what?
Typically by tightening monetary policy, like raising interest rates. Higher rates make borrowing more expensive, which tends to dampen spending and investment, easing the pressure on prices.
Okay. Now, the RBA paper also flags that these effects, they don't happen instantly. There's a time lag.
Oh, absolutely. That lag is crucial. It can take quite a while for the full impact of an exchange rate change to filter through.
Why the delay?
Several reasons. For one, importers might not change their prices immediately. They might have existing contracts, or maybe they price things in Aussie dollars for a while to provide certainty, absorbing some of the initial change themselves.
Waiting to see if the shift sticks, maybe.
Sort of. They might wait to see if it's just a temporary blip or a real trend. Also, even when prices do change, consumers and businesses don't just switch suppliers or products overnight.
Takes time to adjust habits.
It does. People need time to find alternatives, maybe change production processes, adjust budgets. The RBA suggests it can take anywhere from, say, 1 to 3 years for the full effects on economic activity and inflation to really play out.
1 to 3 years, that's quite a long fuse.
It is, and how quickly things adjust also depends on how easily we can substitute between domestic and imported goods. If there aren't good local options, the response might be slower.
Okay, that makes sense. So we've covered the price effects, the activity, and inflation impacts. What about the balance of payments? The paper stresses a difference here for activity, its volume, but for the balance of payments, its value.
That's a key distinction. Economic activity, jobs that's driven by the quantity of goods and services produced and traded. Are we actually making and selling more stuff?
Right.
The balance of payments, though, is like the nation's financial accounts with the rest of the world. It tracks the dollar value of everything, exports, imports, financial flows. It's price times quantity.
Got it. Value, not just volume. So let's use our depreciation example again. Aussie dollar weakens. What's the immediate impact on the value of our trade balance?
Okay, this is where it gets a bit counterintuitive initially. In the very short term, the depreciation makes imports more expensive in AUD terms immediately.
Right.
Even if the volume hasn't changed yet, the value of imports rises straight away because each imported item costs more AUD. Export values might not rise as quickly in AUD terms.
So we're spending more on imports relative to what we're earning from exports in dollar terms.
In that initial phase, yes. So paradoxically, a depreciation can actually make the value of net exports, exports minus imports, worse initially, potentially widening the current account deficit.
Wow. Okay, so it dips down first.
It often does, but then those volume effects we talked about start to gather steam.
Ah, the cheaper exports start selling more, and the pricier imports start selling less.
Exactly. Over time, the increase in export volumes and the decrease in import volumes become more significant. Eventually, this volume effect usually outweighs the initial negative price effect,
Leading to?
leading to an increase in the overall dollar value of net exports, which helps to narrow the current account deficit in the medium to longer term.
So it goes down, then it goes up. Is that the J-curve the paper mentions?
That's precisely it. If you plot the trade balance value over time after depreciation, it often dips down first before swinging back up, tracing out a shape like the letter J.
Huh. Any idea how long that dip lasts?
The paper notes that historically in Australia, that low point, the bottom of the J, often seems to occur within about 6 to 9 months. So the volume response can be relatively quick here.
Interesting. Now, the current account isn't just trade, right? There's also income, what we earn on overseas assets versus what foreigners earn here, net income.
Correct. The net income deficit is another key part, and exchange rates affect that too.
Oh.
Well, a depreciation makes it more expensive for Australians servicing foreign debt that's denominated in, say, US dollars or euros. You need more
Right.
Aussie dollars to make those interest payments.
So that increases the income flowing out.
It does. But on the other hand, any income Australians earn from assets they own overseas, like dividends from foreign shares, is worth more when converted back into weaker Australian
So
dollars.
that boosts income flowing in.
Exactly. Now, here's a crucial point for Australia,
Mm.
mentioned in the paper. A very large share of our liabilities, what we owe the world, is actually denominated in Australian dollars.
Uh, so if our dollar weakens, the amount we owe in AUD terms doesn't actually change for those debts.
Precisely. The interest payments on that AUD debt stay the same in AUD. But the income we receive from our foreign assets does increase in AUD terms. So overall, a depreciation actually tends to reduce Australia's net income deficit. It's a helpful structural feature for us.
That's really interesting. A sort of built-in shock absorber in a way.
You could see it like that. It cushions the blow somewhat.
The paper also mentions valuation effects. This sounds like how the value of our assets and debts changes on the national balance sheet.
Spot on. It's about the Australian dollar value of foreign assets held by Australians and Australian assets held by foreigners, our liabilities. If these are denominated in foreign currency, their AUD value changes when the exchange rate moves.
So if the Aussie dollar depreciates.
The AUD value of any assets or liabilities held in foreign currency goes up. Now, Australians tend to hold more foreign currency assets than we have foreign currency liabilities, meaning that when the dollar weakens, the AUD value of our foreign assets rises by more than the AUD value of our foreign liabilities.
So our net position improves.
Yes. A depreciation tends to reduce the Australian dollar value of our net foreign liabilities. It makes our overall international investment position look healthier, at least on paper in AUD terms.
Wow. So many layers to this. Depreciation isn't just one simple story.
Not at all. It's a complex web,
Yeah.
definitely. And as you said, the RBA has a whole other explainer just on the balance of payments if you really want to get into the weeds on that.
Worth checking out. Okay, so wrapping this up, our deep dive today really highlights that exchange rate moves are, well, a pretty big deal for the Australian economy, hitting us from multiple angles. There were those direct price effects, then the indirect chain reactions impacting activity, jobs, inflation, often with quite a delay.
Yeah, that lag is important.
And for the balance of payments, we've got to think about both value and volume, the old J-curve thing, plus those sometimes surprising effects on net income and valuations.
It's definitely dynamic. Short-term impacts can look quite different from the longer-term ones.
That's a great way to put it. It really shows how interconnected everything is.
Absolutely. You can't really isolate one part.
So for you, our listener, as you process all that, here's something to chew on. We've talked about our dollar moving, but given how globalized everything is, how might big unexpected currency swings in our major trading partners, China, the US, Japan, how might their exchange rate moves add another layer of complexity to everything we've just discussed for Australia?
Good question. External shocks definitely complicate the picture.
Something to think about. Thanks for joining us for this deep dive.